Welcome back, everyone. So, we were discussing Indiana's company in which they purchase raw materials from Belgium every beginning of every month. So, at the first of every month, they purchase raw materials worth 100,000 euros. To buy the euros, we need to use dollars, our own currency, considering we are Americans. So we noticed that in the first month we needed 108,000. In the second month we needed 112, an extra 4K. Why is that? Because price at the market has changed. So basically now we need to pay more USD. Why? Because price of euro appreciated, as we studied in the previous lecture. The bank not only executes the transactions, but also serves as the foreign exchange dealer. So basically here we're saying, now we have two companies, US company, Belgium company. These companies are doing business. So they need to send money from one to another. The basically importer is in the US, exporter is in Belgium. So the banks here are helping, facilitating this transaction through doing two things. Number one, the transfer of money. Number two, the conversion. So basically, you don't really want to go to another dealer, take the USD and change it. You want to do it at the bank. So the bank not only executes the transaction, but serves as the foreign exchange dealer. Each month, the bank receives dollars from Indiana company in exchange for euros it provides. So the American bank is basically dealing with converting USD to euro. In addition, the bank facilitates other transactions for MNCs in which it receives euros in exchange for dollars. However, this same American bank has deals with other companies as well. In these deals, maybe the bank is converting the opposite, dollars for euros and euros for dollars as well. So basically, the banks will have reserves. These banks would need USD. They would also need euro. They might also need different currencies. So they will keep some reserve for each currency. Why? Because they might need it at any moment. Okay. So the bank maintains an inventory of euros, dollars, and other currencies to facilitate these foreign exchange transactions. So it's business for them. How much inventory you will keep, it's based on the market. Basically, let's say the bank notices more people are requesting for Malaysian ringgit. So they will increase their reserve from Malaysian ringgit. So if the transactions cause it to buy as many euros as it sells to MNCs, so if we needed the same amount of euros and dollars, basically we discussed one company needs 100,000 euros. Let's say we have other companies as well that needs USD in exchange for euros, same amount, 100,000. So in this situation, the bank would just basically take the money from A and give it to B. However, usually it's not the case. It's more complicated. You always need to keep some extra in case something happens. So if the transactions cause it to buy as many euros as it sells to MNCs, the inventory of euros will not change. If the bank sells more euros, so let's say this month more people requested for converting USD to euros, its inventory of euros will be reduced. We will have less euros because we didn't expect as much people to come and ask for euros. So let's go into some calculations. Okay, so at any given point in time, let's say we go to the exchange shop, okay, money exchange shop. We want to convert. Let's say we're traveling to the US, we need USD. So we have ringgit, we want to exchange it for USD. Usually when you look at the screen at the shop, you find two prices. Number one, we call it bid price. Number two, we call it ask price. So basically, bid here indicates to buy, and basically ask is to sell. So in the first one, buy. So this, remember guys, that this screen belongs to the shop. So now I am the shop, okay? So this is my screen. My bid price basically indicates the price which I am willing to pay for what you have. Okay, so if I'm going to buy, this is how much I would pay. So you come, you need dollars. Let's say my bid price for USD is 4.0. So you need 1000 USD, you pay me 4000 ringgits. Okay, so to buy from me, you need to pay me this much for 1 unit of USD. Now we look at the screen, we find another column called ask price, to sell. Okay, so basically, if you want to buy from me, if I am going to sell, this is my ask price. I will sell you at 410. Okay, so if you want to buy USD from me, this is how much I'm going to sell USD at. Okay, so bid price is to buy. If you have USD, let's say you went to the US, you came back and you had 100 USD. You want to convert it back to ringgit, you don't need it anymore. So to buy from you, I'm going to pay you 4 ringgits per 1 USD. So I'm going to pay you 400. However, if you want to buy from me, I will sell you at my ask price. So usually we notice there is a difference between bid and ask. Ask price is usually higher than the bid, of course, because I need to cover my cost as a dealer and keep some profits for myself. So at any given point in time, a bank's bid quote for a foreign currency will be less than its ask, which makes sense as we were discussing. So bid ask spread of banks, what's this spread? Why there is a difference? We discussed why. Now we noticed that for other currencies this spread can be bigger. So we discussed USD 4.0 buy, bid 4.10 ask. However, let's say we go to Japanese yen, we notice that the spread is higher in percentage terms, of course. Why is that? Because maybe the cost to deal with this currency is higher. Same with other commodities, guys. So for other commodities, some commodities, you notice that cost is very high. That's why the price or the spread for profitability usually higher. So traders who deal with luxurious basically goods, because these luxurious goods not much people buy and sell, you notice that the spread for profit is higher as compared with bread. Everyone buys and sell bread, high competition, every supermarket offers bread, so you notice the spread is low. Why? Because demand is very high and it's available everywhere. Competition is there as well. Many factors. However, how do we compute this spread, bid-ask spread? Simply by taking the highest price, of course, ask rate, and minus bid rate, the lower price, divided by ask rate again. So let's take an example here. So we are a US currency dealer, exchange shop. We have on our screen two currencies. We have yen and British pound. For the British pound, however, our bid rate to buy British pound from you, I'm going to pay you 1.52, $1.52 per 1 unit of British pound. However, if I am going to sell you British pound, my ask price is 1.60, 5 cents, 8 cents higher than my bid price. So if you want to buy British pounds from me, you have to pay me 1.60 cents of USD per one piece, one unit. So based on the formula, the simple formula above, we notice that the spread rate is 5%. Now let's go to the Japanese yen. 0.007 is the bid rate. So to buy, basically as a shop, if I'm going to buy yen from you, this is how much USD I'm gonna pay you per one unit. However, if I'm going to sell you, my ask rate is the higher price, 0.074. So the bid here is, the spread here, we notice, is higher after applying the formula. It's about 5.4%. So let's continue with an example. Assume you have 1000 USD. You plan to travel to US, okay? From US to UK. So assume you are American, okay? So I am a US citizen. I want to travel to UK. And I need $1,000 for that, okay? However, the bank's bid rate for British pound is 152. So we just discussed that the bid rate to buy from you, they will pay you 152. And the ask rate is the higher, is 160. So before leaving on your trip, you go to the bank and you exchange dollars for pounds. How much dollars you have? 1000. How many British pounds you get? We divide by which price? Ask price. We want to buy. So the shop will sell to us. Okay, so we apply the formula. We get how many pounds? 625 based on this price. However, for some reason, emergency case, we didn't travel. Now we go back to the banks. We don't need the money anymore. I try to exchange it. Now what's gonna happen? I'm going to sell USD. Who's gonna buy? The shop. So the shop will apply the bid price, which is lower, 152. Okay, so we basically convert the money back. How? By basically selling. So now we are going to sell to the bank. We have British pound 625 multiplied by the bid price, because the bank is going to buy 152, we get 950 USD. So remember, the original amount was 1000. Now we have only 950 left. So we lost 50 USD in this transaction. Why? Due to the bid ask spread. You have lost 5%. So this is the profitability of the shop, not the profitability, let's say the revenue, because this money is supposed to cover some costs. So it's less than what we started with. Obviously, the dollar amount of the loss would be larger if you originally converted more than 1000. So can you lose more? Of course, if you transact with more than 1000. You transact with 2000, you lose 100. 4000, you lose 200, etc. So why there is a difference in the price? Why the bid ask spread is there? These shops or banks say we need to cover some costs. Okay, so we have something such as order costs, cost of processing orders. We need an order, we have people making orders, maybe need machines, new technologies are there every day, including clearing costs and costs of recording transactions as well. We have inventory costs. Remember, this is currencies. You cannot keep it anywhere. You need an inventory, you need safes, you need security guards, etc. So cost of maintaining an inventory of a particular currency. Number three, we have a factor called competition. It always plays a role. We discussed competition will always affect demand and supply and price. So the more intense the competition, the smaller the spread. Why do you go to Bukit Bintang if you want to convert a large amount of money? Why don't you do it at the malls? At every mall, you can find an exchange shop. You say, because I want to change 10,000 ringgit. So their price is not good, right? By saying this sentence, I am indicating that the spread is larger in the malls. You go to Bukit Bintang, there is many shops, so more competition, higher competition. So you try to check the spread and you notice it's lower. Why? Because these people need to attract clients. And since there is many clients and many people offering to exchange, so supply is high as well. So we notice competition is strong, which makes the spread lower. So you need to sacrifice a bit of your profits if you are in Bukit Bintang. Why? To attract more people by lower price. Next, we have volume. We discussed that. Liquidity. Currencies that have large trading volume are more liquid because there are numerous buyers and sellers. You feel safe when you have USDY because, you can sell it even to your friend, your neighbor, your mother. Anyone would buy it from you if you really need ringgit. No one would really mind. Finally, we have currency risk. Okay, so when you keep USD is different from when you keep Malaysian ringgit, which is also different from when you keep, let's say, Lebanese lira. Nowadays, Lebanese lira is depreciating massively every day. So if you keep Lebanese lira, you already know that you might lose money. Why? Because it's depreciating in value. So to sacrifice for that, basically, you need a high profit, right? So high risk, high profit. So you notice the spread for Lebanese lira is very high, and not many shops would have it in the first place because it's high risk. So economic or political conditions can cause the demand for supply of the currency to change abruptly. Okay, let's move now to direct versus indirect quotations. Okay, so what does direct quotation mean? Okay, so there are two different ways of pricing, which is like two faces for the same coin. So it's the same coin, but how you look at it, it's like 2D dimension. You can look at it from two sides. Let's discuss direct first. Direct means how many local currency I need to purchase one foreign currency. Okay, so this is the quote. If you say direct quotation for USD, I already know. You need, as Malaysian, I need one basically USD. So how many ringgits I need to pay? So here you see between the parentheses, example, $1.4 for euro. This is because the example is for US people. Okay, so this is in USD. In Malaysia, it's basically 1 USD foreign currency, 4 ringgits. In US, 1 euro, how many USD? Because USD is the local currency. Now, on the other side, we have indirect quotation. Indirect is the opposite, basically. The number of units of a foreign currency per one local currency. So let's go back to the same example. As US people, our indirect quotation would be something like 0.7143 euros per 1 USD. So how many foreign currency units can I get for one local currency? The opposite of the previous. So which price is correct? Both are the same, basically, right? One is in US terms, so to buy 1 euro, you need 1.40 cents. However, if you want to look at it the other way around, if you want to buy $1, you need 7143 euros, 0.7143. Now let's go as Malaysians. So as Malaysians, direct quotations is how many ringgits I need to buy one foreign currency, USD. You need 4.17. Now what's the opposite? What's the other face of the coin? If you want to buy one ringgit, one local currency, we call it indirect quotation. How many USD? 0.239898, sorry. Okay, so let's take a look at few currencies here in the table. We have direct quotation, number one, then we have indirect quotation at the beginning of the semester and at the end of the semester. Of course, the price changes. So we notice that the direct quotation is 0.66 cents for one Canadian dollar. So what's direct? Remember, direct one foreign currency, how many local currency units to buy it. Okay, so one full Canadian dollar equal 66 cents of American dollar. What about the indirect quotation? One USD, one local currency, how many foreign units? 1.51 Canadian dollar. So to buy one USD, you need 1.51 of Canadian dollars. However, the price changed after a few months. Now you notice one Canadian dollar equal more USD. So Canadian dollar appreciated. Now you need 70 cents, excuse me, to buy one Canadian dollar. Let's take a look at the indirect quotation at the end of the semester. We notice that you need one less Canadian dollars to buy one American dollar. So you need $1.43 only to buy one American dollar in comparison to 151 at the beginning of the semester. Okay, so we can take a look at other currencies and compare. So to recap, one, basically direct quotation first. So what's direct quotation? One foreign currency, how many local currency units to buy? What's indirect? The opposite. One local currency, how many foreign currencies to buy? Okay. So basically, this is an observation. So direct versus indirect exchange rate when the euro is appreciating against USD. So when euro is appreciating against USD, so euro is becoming stronger based on an upward movement of the direct exchange rate of the euro. The indirect exchange rate of the euro will be declining. Let's go back to understand this. So take a look at the euro. You need how many dollars to buy 1 euro? In the direct quotation, we notice you need more than a dollar, $1 and almost 3 cents only. However, we look at the price at the end of the semester and it's 1064. So now you need more USD to buy 1 euro, right? You need to put more cents. So it's an upward, so it's increasing. The direct quotation looks like this, increasing. So when it increases, what does it indicate? Indicates more appreciation of euro against USD. How about the other face of the coin? It's the opposite. It would be going down. So take a look at the indirect quotation. 1 USD equal how many euros, how many foreign currency? 97 cents. How about the end of the semester? Declining. Now 1 USD equal less euro cents basically. So you need only 94. Of course, it's the opposite direction. Okay, so when the euro is depreciating, as we discussed, based on a downward movement of the direct exchange rate against the dollar, the indirect exchange rate will be rising, always the opposite direction. Where do we get quotation? If you want to, get more info on what I'm talking about, you want to observe these changes, how does it change? One good source I really follow is Yahoo's website. You just Google what's written here, Finance Yahoo. And the exchange rate quotations are also provided by many other online sources such as Oanda.com. You may check these two websites. I'm sure you're gonna like one of them at least. Let's continue with a numerical example. Now, in the previous class, we discussed cross rate as well. We said, let's say, we know how much is it to buy USD in euros. We also know how much is it to buy USD in ringgit. Based on these two information, I can simply calculate the price of euro to ringgit or ringgit to euro. It's like a triangle. I have one missing piece. Okay, so cross exchange rate is the amount of one foreign currency per unit of another foreign currency. Example, so again here we are Americans. So value of peso. So 1 Mexican peso equals 7 cents USD. How about Canadian dollar? 70 cents USD. So to buy 1 Canadian dollar, you need 70 cents of USD. And to buy 1 peso, you need 7 cents of USD. So basically, this is direct quotation. So what's the value of peso in Canadian dollars? So based on these two information provided, give me a third information. What's the value of peso, Mexican peso in Canadian dollars? So I know peso in USD, I know Canadian dollar in USD. Now I need peso in Canadian dollar. The question can be also Canadian dollars in peso. However, here the question is clear, saying the value of peso in Canadian dollars. So if you want to buy peso using Canadian dollars, how many units of Canadian dollars do you need to buy 1 peso? We simply divide the first currency by the second currency. So value of peso, we put the peso on the numerator and we put the Canadian dollar on the denominator. We notice it's 10 cents, which makes sense, right? So you need 10 cents of Canadian dollars to buy 1 peso. Can we also get cross exchange rates? So let's say you are Malaysian, you want to import from Mexico. Can you get the cross exchange rate? It's also provided on Yahoo's website. You can take a look. Let's continue with foreign exchange market and currency derivatives. So what's a derivative first, before I begin? A derivative is a financial instrument. Okay, what does the name indicate? Derivative. The value of this thing is simply derived from something else. Okay, that's why it's called a derivative. Okay, so a currency derivative, as the name suggests, it's an asset, financial asset, instrument, and its value will be derived from currencies. Okay, so basically the price might change here not because of the derivative itself, but simply because of changes in the price of the original currency. So a contract between seller and buyer whose value is to be derived from an underlying asset. Here it's a currency. Now what about forward contracts? Again, the name indicates forward, in the future. Agreements between a foreign exchange dealer and an MNC that specifies the currencies to be exchanged. So McDonald's need the Malaysian ringgit, okay? When they know exactly when, at the beginning of next year. So they can make a deal to get the exact amount of ringgits at the exact day. So it will specify the currency, what currency ringgit, exchange rate 1 USD 4 ringgits, and the date 1st of 2020 to which transaction will occur. Why are we fixing all of these things? Because as McDonald's, I don't want to have trouble with the price. I want to compute my cost and be sure my supply will be ready at that exact day I have business to carry. So the forward rate, what is the forward rate? Of course, it's the rate in which we will transact in the future. So it's the spot rate in the future. It's the exchange rate specified by forward contract. What's the forward market? It's a platform to transact forward contracts. So it's over the value market where forward contracts are basically traded. Now let's move to currency futures. Okay, again, future. It's similar to forward, right? It's some contract in the future. However, there is some similarities, there is some differences as well. Similar to a forward contract, but sold on an exchange instead of over the counter. Okay. So if you need to transact in a forward contract, I need to go over the counter. I need to go to the bank during working hours and make a deal, okay, for a specified amount. 110,522 ringgits. Exact number I need. However, in futures, you don't need to go to the bank. You can just go to the platform and buy. Second, you cannot get an exact number as you wish. There is a standardized volume. You either buy 10,000 or 100,000 or 500. Okay, so it's sold in bulks like this. You either buy or not buy. So let's read together. It specifies a standard volume of a particular currency to be exchanged on a specific settlement date. The future rate is the exchange rate at which one can purchase or sell at specified currency on the specified settlement date. So it's the spot rate in the future. For you, basically, only for you, not for others. It's what's in the contract, it's for you. The spot rate might be different at that time in the market. So the future spot rate is the spot rate. This is the future spot rate, sorry, okay? So this is the rate that will exist at the future point, and it's uncertain as of today. So to avoid the changes in this price, I basically entered into the future contract, and now I have a future rate. I know what's my rate. I don't have to take the risk and wait until 2020 and go to the foreign exchange market to buy, because I am not sure it's going to be the same, as of in my contract. So if it increased too much, it might be too much for me. So the trade will not be good anymore for me because of this increment. Okay, let's continue with currency options. Now, the final instrument of derivatives I want to discuss is options. We discussed contracts, right? Forward contract, future contract. Now we're discussing an option. So here we are discussing, I want to have an option to buy 100,000 ringgit at the beginning of 2020. Okay, of course I'm ready to sacrifice some premium, we call it. Of course I'm gonna pay you some money for giving me this option. Okay, so we have two different options. What do you want? Do you want to buy or do you want to sell? Okay, so if you want to buy, we're gonna call it a call option. Okay, so it provides the right to buy a currency at specified strike price. We're gonna call it a strike price. Which price? The price I'm paying you a premium to offer me, okay, to buy you in the future. So now I have an option to buy 100,000 ringgit for USD at a specified rate. We called it strike price. 1 USD equal 4.10 cents of ringgit. Now we have the put option, the opposite. I want to have the option to sell you a specified amount of currency, not to buy from you. I want to have an option either to sell or not sell. How? I will pay you some premium, okay? So let's say you need USD. I will have 100,000 USD at the beginning of the new year, 2020. However, I don't want to keep it in USD. I want to convert it to ringgit and buy something, okay? So to do that, I need someone to buy 100,000 USD from me on the beginning of 2020. So I need a put option. I need an option to sell this amount, okay? So if I didn't receive it or if I didn't like the strike price at that time, I will simply say no. Okay, so there will be a premium I'm ready to sacrifice for this transaction. Let's say I found someone who's willing to offer me this for 1,000 ringgit. So I'm fine with losing 1,000 ringgit if I didn't like the strike price at that time. Okay, so how you wouldn't like it? By comparing it to the spot rate after at the beginning of the new year, right? So come 2020, my strike price is 410. I look at the market and I compare with the price in the market and I compute my cost, the premium I paid, right? So after this computation, I will decide whether I should proceed or not proceed. Corporations or governments need short-term funds. Now we're moving to money market. Okay, so we're done with exchange market. So what's money market? Governments need money, short-term. What about companies, big companies? McDonald's, let's say, demand decreased during Corona, so they still need money, right, to pay salaries, etc., rent. So they might need to borrow. Do you think they will collapse? No, I don't think so. But this year is not good for them. So maybe they need to borrow for 1 year, right? So where would McDonald's find this big amounts of money for them to borrow from? We call this money market, where you buy and sell, or sorry, lend and borrow. So the international money market has grown because firms may need to borrow funds to pay for imports denominated in foreign currency. So big businesses, they might expand their business massively in 1 month. Why? Because higher profits. How do they expand the business? How do they buy raw materials? They simply borrow. They may choose to borrow in a currency in which the interest rate is lower. Where do they usually borrow? They might, of course, try to find a low interest rate so they don't pay a lot extra money. And they may choose to borrow in a currency that's expected to depreciate against my currency. We discussed that in previous class. I need to borrow money, okay? Shall I borrow from Thailand or Singapore? However, if you look at the history of the currencies, this is an assumption only. Let's say that we found ringgit is appreciating against Thai, okay? Thai baht, okay? So meaning that the baht is depreciating against us. So you need less ringgit to buy baht. Let's go to Singapore. We notice that the Singaporean dollar is appreciating against us, meaning that we are depreciating against them. Okay, so with time you need more ringgits to buy 1 Singaporean dollar. So where shall I borrow from? Of course, Thailand. Why? Because Based on what we have of information, the price of ringgit is appreciating against Thai baht. So you need less ringgit to buy Thai baht and pay the bank in the future. Based on assumption, of course. You might come to me after 1 year and say it didn't work. The baht appreciated more than, of course, it might happen. But based on what we know, we try to find a currency in which our currency is appreciating against. So later on, after 1 year, when we need to pay back the money, we convert our money to their money, and our money would be worth more. So we can pay easily. In the opposite scenario with Singapore, we convert the money and we notice our money is worth less than what we had at the beginning of the transaction. Okay, let's continue with money market interest rates among currencies. So, the money market interest rates in any particular country are dependent on the demand for short-term funds by borrowers. So, what determines interest rate? Why is it 5%? Why is it 6%? Why is it 0.10 in some countries? Okay. Of course, due to, again, what we discussed, the powers of supply and demand. More people want it, less people want it. So here we're discussing interest rate. How does this work? More people want to borrow. So if more people want to borrow from you and you have limited amount of funds, you only have 1 million ringgit, and everyone wants to borrow, then you might ask for a higher interest rate because you know they need you, right? Now, what about the opposite case? No one needs to borrow. Everyone has his own money. No one needs your 1 million. So you will start make good offers for me and them, right? You would say, okay, you can use it and pay me 1% only. Why? Because you need to profit and no one is looking to borrow from you. So when more people want to borrow, interest rate usually goes higher. Money market rates vary due to differences in the interaction of the total supply of short-term funds available, bank deposits, in a specific country versus the total demand for short-term funds by borrowers in that country. Now let's continue with the global integration of money market interest rates. So as we discussed, when economic conditions weaken, let's take the corona as an example. Businesses are suffering, people are suffering due to that, of course. So when the employer suffers, the employees suffer as well. Corporate need for liquidity declines. So now, people are trying to cut costs, right? We know we don't need this, we'll do it indoors. We don't need this, let's try to do it. And you notice your job is sometimes doubling in amount because the employer tries to fire some people, and of course this pressure will basically be converted to others, of course. And corporations reduce the amount of short-term funds they wish to borrow. Why? No need for obligations. I don't need to borrow. I don't know if I will be able to repay. So better I shrink the business maybe for now. However, on the contrary, when economic conditions strengthen, when the economy is very good, you remember a few years back, tourism in Malaysia was super good, everyone is selling his goods, everyone is happy. Too many people are buying products from our businesses in Malaysia. We are importing. At this scenario, there is an increase in corporate expansion. So businesses want to get more and more shops, more and more clients. You notice marketing increases as well. So for this, you need money. So you notice borrowing increase as well. So let's continue with the risk of international money market securities. So international money market securities are debt securities issued by MNCs. So we discussed money market. Now let's discuss the instruments themselves. So I am McDonald's. I need money for 6 months. I don't know what to do. One option is go to the money market. Now, what shall I do in the money market? I can borrow money and pay some interest. Okay, so they are debt securities issued by MNCs and government with a short-term maturity. So this company will issue certificates. Who would buy? People who want these certificates. So the demand for these certificates will be based on the name of the company. Of course, do you trust McDonald's? I do. Rate, how much interest you're gonna pay me? High interest, more people will buy. Okay, so what does the certificate say? It says that after 6 months I will pay you back this amount of money plus this specific interest rate. Normally these securities are perceived to be very safe from the risk of default. Why? Because it's less than 6 months. Do you think McDonald's, even if Corona continued, do you think McDonald's might be out of the market in 6 months, meaning that they would not have enough assets to repay you? I do not think so. So these gigantic companies, people don't really expect them to default in the short term in less than 1 year. Maybe in 5 years, I don't know, but I don't see the company defaulting on paying debt in 6 months. So even if the international money market securities are not exposed to credit risk, they are exposed to exchange rate risk. So default risk, credit risk is not really high. Why? Short period of time. So I don't expect you to have really major issues during 6 months. However, I am still exposed to exchange rate risk, right? When the currency denominating the securities differ from the home currency of the investor. So let's say you didn't borrow in your own currency, you had to borrow in a different country, in Mexico, in Mexican peso. So now you need to pay back in Mexican peso. So now maybe the risk is there higher than the risk of repayment. So repayment is not very high because we said the period is short. However, when it comes to this, the risk can be higher because who knows what can happen to the exchange rate. Okay, so we will end this part here. In the third and next part, we will be discussing international credit market. Thank you very much for listening. Wassalam.